Good morning, ladies and gentlemen. Well, what a turnaround and what a difference a week makes. The risk dial has gone from the high 20s all the way to 84, nearly the maximum score, indicating that stocks are to be preferred to bonds over the longer time frame. I apologize, the charts are not updating. We'll try and fix it today, but you can see the scores over the past week. We went from 29, jumped up to 42 before the election, and now we are at 84. And I have every confidence that we will see even 100 in the days ahead. So on the daily and the weekly, we have no doubts. We have new highs on the whole move, indicating that at some stage over the next couple of weeks, I certainly expect the markets to make new overall highs. The moving averages are all moving out, and I think we are in the next leg higher. Deviations are also showing you the potential of the market. I think over the next few days, SPY goes into the test zone ahead. But the one that's most interesting to me and that I will be showing you and talking a lot about today is EEM. That's gone into the red. You might have a little dip, but that dip I think is a buy. We have wonderful definition. The market in no way should go below this center line now, and I think from now on until the end of the year, EEM is just going to rip higher and be the new leader. As I said last week, if bonds hold, the market will hold, risk will hold. I think the two are very much in a symbiotic relationship at the moment, and that cannot really change until we have some sort of a vaccine and the earnings can grow. At the moment, all that can happen is that multiples can expand and contract, and that is completely determined by the value of the yield curve and where it is. Look at it, last week we bounced off the 75 level and came down, we held, and now basically I think we are going to be in a range between the 50s and the 70s, and we are going to just go up and down trading in that range. If we start breaking above 75, the yield curve will start, it'll be a sign that we are really steepening, and that to me cannot be good for risk in terms of it just will not allow risk to expand, the multiples to expand that much. But I don't expect it to happen. I think we're now in a stability period between the 50s and the 75s. That stability continues. In terms of all the other spreads, especially the 5s, 30s, it's quite obvious that this 120 to 123 area is key for the 5s, 30s. We got there, we couldn't break, we're going back down, doing some sort of a double bottom. But as long as that 140 level holds, I think that is a sign of stability. We might get a little bout of risk off if we start breaking the lows that we determined before around the 128 to 129 area. But as long as 140 holds, to me, the natural trend is going to be for a buy the dip kind of scenario in the risk, i.e. in equities. I don't see that changing for quite some time yet. I will be basically a buyer around 138, 140 for a move back towards these levels around the 123 area. As long as the yield curve only moves 1, 2, 3 basis points, that is not a reason to sell equities. That is a reason to buy dips. Looking at the longer end outright, TLT held exactly where it should have done and basically retraced to exactly where it should have done and backed off. To me, that is a sign of stability. If we try to enlarge this area, you can see how well it's really trading technically, bouncing off 162 and basically now we are in this 162, 155 range kind of thing. We will probably test both sides, but eventually this is going down towards this 150, 149 area, but it's going to take an awful long time, and that's okay. There is absolutely nothing wrong with taking a long time to go there. That allows the market, the risk market, to buy a dip and continue higher, buy a dip and continue higher. It just means that if we are going towards 150 very slowly over the course of 3 months or so, that allows the market to expand the multiples, but not very much. And that to me gives time for a vaccine to come along and for expectations of higher earnings to actually take the market higher eventually. So it looks like it's a buy the dip at good levels kind of market, and this is not going to stop it. This kind of slow grind down is not going to stop it. But to me, and I will show you some spreads later on, bonds are probably still the worst market to be invested in. It looks to me like it's gold, equities, and finally bonds. Gold and equities tying for first place. Bonds are definitely in last place. With Powell being back in charge, as Biden does not have a majority in the Senate, and also the election having been so close, the mandate is very weak. The odds of doing Green New Deal policies all over the place are firmly on the back burner. There is no alternative to Powell continuing doing more and more QE that slows down that move in bonds that I've just been talking about. Just slowly allows the yield curve maybe to steepen 1-2 basis points over the course of time. That actually to me is bearish, the dollar. I think the dollar has broken on a weekly. We closed below this 92.62 level, which I thought was so important. On the dailies here, we are now opening up the Bollinger Bands, but even that looks like it's going to be slow, and it's going to take some time to get down to this 91.01 level. But eventually I do expect it to see this mid 88s. Sometimes this year. Bounces really should not be higher than 93.63. I was waiting for the 95 to 96 area. Didn't see it. From now on, around 93.63 should be the bounce that you look to sell. And really, I would be surprised if the market even gives you that opportunity. I think over the course of the next couple of weeks, we descend down to 91, and as I said, eventually down to this 88.40-ish area. In terms of Euro USD, as you can see here, we've had the second highest weekly close. The trend should be to go and test the Bollinger Bands on the weeklies on the upside around this 121 something area. I think it's going to be slow progress, but I definitely expect this high to be taken out at some stage over the next couple of weeks. I don't think we're in a very strong trend, certainly not in Euro USD. I think we are in a stronger trend when you have a look at Asian currencies. And this is a longer term chart of the yen. I think this pattern is, as you can see, it's on the dailies and on the weeklies, it's quite weak and quite strong. I think at some stage we're going down towards this 100 level. We are, as you can see, we've been trading very well within the Bollinger Bands. We're slightly extended. I'm looking for bounces up to 104.60 to sell. Why not? We are through the Bollinger Bands on the weeklies and on the dailies. A few bounces will be very welcome. But I think the path of least resistance looks very much to be down towards that 100 level. Certainly the Bank of Japan is going to be defending that 100 level. I don't think they're going to let it, and that is why that's a 3% move down to 100. 3% over the course of 2, 3, 4 weeks is not going to worry anyone, and that should enable the Dixie to get down to that 88 something level. But from everything that I look at, the Asian currencies are the ones that are going to push it. It's Asia that's going to push it lower. That is very good for what I've been saying for a long time, Nikkei and EEM, which we will look at later. Well, if the trend for the dollar is lower, and if bonds are not really going to stand in your way by having a much steeper yield curve or a much higher level, absolute level of yield, the path of least resistance for gold is always going to be up. The Fed wants inflation. They're going to try their damnedest to resurrect it. So, people are going to be dip buyers in gold. And if the US dollar is contributing to the overall weakness, then gold is going to be quite strong. We didn't manage to close above the 1959 on the weekly. But that's because we are just about on the daily Bollinger Band. But we have closed above the 1930 level, 38 level, which I said would be the first sign of strength. We have the first sign of strength. Odds are that maybe after some indecision and testing down to the 1920s, we do go up and we break 1960 and retest these levels around 2000, and most importantly 2022, 2024. If we take out 2024 in the next couple of weeks, I have no doubt that before the end of the year we will be testing the all-time highs and going through them. I think over the next couple of weeks we are trading between 1925 and 2020, 30, something like that, and then a bit of consolidation and we break higher. As far as stops, it's now, you can almost write the stop. The stop is a close below 1860. We've bounced off 1860 so many times, and as I said, 1860 very pivotal now. I don't expect it. I don't expect even a test anywhere close. The lowest I expect is somewhere around 1910 to 1920, and then we bust higher, and sometime before the end of the year we trade up in the 2000s and try the all-time highs. That will be probably enough for me, I think. I think the stability here is enough. If gold goes 5% from here by the end of the year higher, I will be quite pleased. I'm only looking for 3% lower in the US dollar. 5% higher, 5 to 10% higher in gold is going to be quite enough. And now, before we go over to the US markets, risk markets, let's examine what I think are the two charts, or the two markets rather, the Nikkei and EEM, which are, if not the leaders, certainly the pathfinders for risk. It is, Nikkei closed at a new record high, indicating that its trend is just about starting again. I am looking for 26 to 27,000 by the end of the year in Nikkei, and that's nearly a 10% move from here. It is through the daily Bollingers and the weeklies, it's overbought. If it gives you any chance to buy a cup and handle kind of pattern, I'm definitely going to take it again. I am long of Nikkei. I've been banging the table about Nikkei for a long time. I will continue to do so because I think it's the one that's offering you the best risk reward. You can see how the dips are much shallower than the US, and the rips are nearly as high as the US, indicating to me that it has a much better risk reward in terms of longs. Any kind of move back down, I doubt it breaks now 23,800 area. Any kind of dip to there is going to be a great place to get long, and as I said, I think we go to above 26,000, 27,000 without any problem by the end of the year. And here is EEM, target achieved 47.93. Maybe a little dip. No way should it dip below 45 again. I think we are set to test the 52 level over the course of the rest of 2020. At some stage we trade 52 for sure. I think the risk reward, the EEM, is better than in the US. If we have a look at the EEM spreads, we don't really have any problems. Excuse me while I readjust these. This is EM against the variety of markets. Let's see. First one here is Japan. You can see how it's actually even positive against Japan, which I like very much. It's also positive, it's looking quite good against the SPY. It's certainly not going down anymore. It's holding pace with SPY, and it looks to me to be a much better risk reward in terms of downside. I would love to see it test these kind of levels against 15 again, and that's like a 10% outperformance. And here, against Germany, it's showing that it's much better than Europe. It's showing that it's at least as good as the US and Japan, which is one of the leaders. So to me, EM is a space that you definitely want to own for the longer term. I think the target for this year is certainly 52. Any dip anywhere near 45 is a buy the dip for a move to 52. Well, here we have SPX. I think there's no doubt that first of all we trade 35.50 and then we attack the 35.88 level. Are we likely to see this market actually go over it? I'm not really sure. This is where we have the Bollinger Band resistance, and SPX trades very well within the weekly Bollinger Band resistance, but I really do expect it to trade up to this all-time high next week. On the chart that I like most and for the short-term trading, which is the 195-minute chart, you can see how we never closed below the 35.01. I was hoping to get it down to 34.28 and buy call spreads to go up to 3600. Didn't get them, so the market is saying 35.01 is the new 34.28. So that is the new swing pivot. Closes below 35.01 are going to be bearish for a retest of 34.28, but in the early part of next week I do not expect that. I expect an immediate move up to 35.52, and it expands over the course of 2 or 3 days, a retest of this high. If we look at the dailies, that is quite possible, isn't it? We don't really have the Bollinger Band resistance until we get up to there, and this gap fill, we're going to get that gap fill, and then we're going to see if we develop some sort of divergence and we can come back down towards 34.28 and then go again. But certainly I don't think that the US is going to be nearly as impulsive longer term as EM or Nikkei or Asia in general. It just doesn't show that to me on the charts. Likewise, NQ, the levels are particularly clear now. 11,850, first big support. 11,566, massive support. But the path of least resistance is for an immediate gap fill around the 12,300, 12,400 area. If we look at the weekly chart, well, that is precisely, when we open up next week, we're going to be somewhere around here. 11,400 looks absolutely assured to trade next week. As long as we stay above 11,560, there is very, very little danger to buying a dip. It looks like a continuation, and if I look at the spreads, I really don't see very much of a problem, and we'll look at those in a moment. The spreads against technology, whichever one you look at, whether it be XLF, XLK, XLV, XLK, XLI, XLK, here the Qs against that IWM, the NDX against the SPY, it's all showing an upward tendency now, and even SPY QQQ, which on Friday had a chance to reverse, is now closing and into all-time highs. That to me says that technology is going to be just fine. And why shouldn't it be? The bonds have reversed, they're holding, the yield curve is not really steepening that much. If it steepens 1 basis point, 2 basis points, nothing to write home about. So QQQ and technology can continue on their merry way. I think the path of least resistance is an immediate test of higher levels early next week. The last thing I want to mention is the ITOT over government. This is the weekly chart, this is the daily chart. Let's examine the daily chart in more detail. It held precisely where it should have held, and at the election it reversed. Now it's threatening the all-time highs. This level here is absolutely key. We close above it, it's big time risk on, and we're going to have a big time continuation of prefer equities to government bonds, risk on, whatever you like to call it. I think that at some stage by the end of the year is almost inevitable. It's showing me that gold and equities are favored very much over bonds, and that is going to be the trend for the rest of 2020. I'm going to wait for the signal, because that is the intelligent thing to do for the timing, but it seems to me that that is almost inevitable, that we're going to get it at some stage in 2020 and get the continuation in Q1 of 2021. I prefer, as I told you, EM and EWJ, i.e. Japan, because I think the risk reward there is better, i.e. the risk is much lower and the reward is not is not a million miles away from what you can get in technology or in the SPX, but it's a question of timing. Volatility was the big loser, as expected really, and now the most important level is going to be that 2251. Can we close the week below 2251? Because if we can, then we are more likely than not to go down towards the 16 level, and that will give us but this is going to take weeks and weeks and weeks, and that is going to give us that rally into year end, and the testing of the all-time highs, and especially here in technology we can go down towards the 20 area, and that will give us the technological lead that the spreads in technology say shouldn't be much of a problem into year end. It's you know, to me, it's very, very unlikely that we have deep dips now in the risk sector. You know, it's all becoming much more certain. It's a question of which dip you buy and at what level. And I think I showed you the levels that I have. I think 3501 is going to be very close, you know, a good level to buy calls now. And here is the summary sheet. I don't think there's any change in the 2 stands or 530s as long as that 140 level holds and the moves are 1, 2, 3 basis points. The risk market is going to be fine. I think the action is going to be in DXY and gold, DXY to the downside, gold to the upside. Here you have all the targets. I would expect 2024 in the next 1 or 2 weeks for sure to be tested. I think on the downside, 1860 is absolutely crucial now. That can be a very hard stop on gold positions on a closing basis, of course. And here we have XPX. It's bonds held, targeting highs. It's as simple as that. There's very little resistance before. Oh, sorry, that's supposed to be 35, 80, 90, and you know we are fine. There is nothing wrong with XPX or NQ that I can see, but EM and Nikkei to me are better. I think any kind of dip towards 45 is going to be a very good buying level because 52 will trade sometimes in 2020. And the Nikkei to me is interesting because any dip down to 23,700 or 23,800 is really a wonderful opportunity to be looking for 26,000 into year end. Thank you very much indeed, and tweet you on Monday.